Good evening.
Good evening.
Great. That's why Mwalimu is audible. I hope all of us, you are all well. So we just pick it up from where we left in our last class. So we pick it up from where we left in our last class. So I'll just do a recap on what we did so that at least all of us, we should be on the same page. Just a quick recap on what we did. So remember in our last class, of course, we had introduced the component of variance analysis. And in that class, we agreed that we'll be having 5 main components. And in that case, I think we analyzed a bit of them. So just a quick recap on what we did under variance analysis. Just a quick recap on what we did under variance analysis. We agreed that variance, basically, it is simply the difference between whatever that you budgeted and, of course, what the actual results are. So that is one main fact that you should always be able to understand when you're dealing with variance, that all you're looking at is simply the difference between our budgeted and the actual results. We said that variance will be categorized into the following items, where we talked about the material cost variance, material cost variance. We say that this will be looking at 2, material price variance and material usage variance. We talked about labor cost variance. So under labor cost variance, recall the same element we said that we'll be looking at 2, labor rate variance and labor efficiency variance. We said we'll be having our overhead variances. And considering our overhead variances, key element would be 2. Number 1, consider the item of fixed, or we start with variable OHD variance. Under variable overhead variance, my good students, we said we should be able to recall that we have 2 components. That is variable overhead expenditure variance and variable overhead efficiency variance. Under that, we talked about the fixed overhead variance. So under the fixed overhead variance, we said we have 2 components. That is fixed OHD expenditure variance. And we talked about fixed OHD volume variance. We agreed that fixed overhead volume variance, these are special child. These are special child because it will behave opposite compared to the other forms of variances. And where we left, where we are supposed to start from, this was about the sales variances. So that is where we are supposed to start from, the aspect of the sales variances. That is where we are supposed, of course, to start from. So when looking at the sales variances, the whole idea still remains the same, that we are looking at what? The differences between budgeted and the actual. So key element under sales variance, you should recall that we have 2 components. Number 1, what we normally refer to as the sales sales price variance. Let us talk about the sales price variance, my good students. Let us talk about the sales price variance. Okay? So this is simply the difference between, this is the difference between the budgeted selling price per unit. This is the difference between the budgeted selling price per unit. This is the difference between the budgeted selling price per unit and the actual selling price per unit. This is the difference between the budgeted selling price per unit and the actual selling price per unit. And the actual selling price per unit based on the actual units sold. Based on the actual units sold. Based on the actual units sold. Difference between the budgeted selling price per unit and the actual selling price per unit based on the actual units sold. Based on the actual units sold. Very important to note. And when looking at that, we should be able to understand that for us to determine our sales price variance, we are looking at this difference, price. We are looking at price. So therefore, it is the difference between the standard selling price per unit and the actual selling price per unit based on the actual units sold. Where, in this case, SP will give us standard selling price per unit, standard selling price per unit, AP will give us actual selling price per unit, whereas the Q will give us the actual quantity of units sold. Actual quantity of units sold. You see? So we need to understand that we are looking at the difference. That is majorly what we are interested in. And the potential as the main item that we should concentrate on. So once we have considered this should take us to the sales volume variance. Sales volume variance. Sales volume variance. These are another key elements that we need to understand. So looking at the sales volume variance, all that we need to consider, my good students, we are looking at the difference in the quantity, the difference in our output. We are looking at the difference in our output. So what about this? We are talking about, this is the difference between, the budgeted output, this is the difference between the budgeted output and the actual output. Difference between the budgeted output and the actual output. And the actual output. And the actual output valued at standard profit per unit. valued at standard profit per unit. So we're saying that when you're talking about the sales volume variance, we consider our output, budgeted output minus actual output. So this one is valued at the standard profit per unit. The O, these are budgeted output. The O, this is the actual output. SP, standard profit per unit. Standard profit per unit. That is the standard profit per unit. So very important to note. Standard profit per unit here. Standard profit per unit. Very important to note that. So we have it. Another key element that you must be able to understand here is this fact. When we are still under this case, we are still under this case, we're still under the sales volume variance, okay? When the fixed OHDs are not absorbed, when the fixed OHDs are not absorbed to the production, or are not absorbed in the production, are not absorbed in the production, then our sales volume variance will change. Where our fixed OHDs are not absorbed in the production. And you'll always be told, if at all they are not absorbed. When the examiner is silent, you take it as if they are absorbed into the production. But where the examiner will specify that these overheads are not absorbed into our production, then these are what you must always tend to note. That our sales volume variance will be determined as follows. Budgeted output minus our actual output, valued at what? Contribution margin, standard contribution margin. Standard contribution margin. Very important. Standard contribution margin. That is where the good examiner specified that your fixed overheads are not absorbed into the production. Then we have to master and get that very well. You have to master and get that very well. So that is important, very important to note. Great. So you think that at this point you're having, let's consider a question. Let us consider this case. Of course, from our past paper, we can check. So key element, we've said that once you're good with these aspects of the formulas, then you'll find that our case will always be very easy, of course, to handle. Concepts will always be very easy for us to be able to handle, yeah? So maybe you can consider these various questions. There's a document that I've shared there, which it is for intermediate level, yes, I believe. So these questions, you'll find that whatever that we have and that of intermediate, they are more the same, only that right now in advanced, of course, we'll be looking at other elements which are the mixed component of the mixed variances and yield variances. This is the only difference compared to what is there in intermediate level. Compared to what is there in intermediate level, it is only on the component of the fixed, or rather the mixed and the yield variances, but all the rest are just the same. So there's a document that I share the past papers for the intermediate level. I want us to consider like some questions there, then you jump to the advanced and you see the relationship so that we have a wide base of questions to train in. So we go to that past paper. We go to that past paper and you can consider the following. We can talk about, of course, these simple concepts. We want a question with full bit. Consider this question in April 2023. April 2023. I've jumped. Okay. Of course, there are so many questions, but I want us to consider these questions in April 2023. April 2023. That is question number 5, part B. Question number 5, part B. Question number 5, part B. So that is a document for MA. What I've shared right now. So let us look at this question. Let's look at this question. These are what we are told, that the X Limited manufactures a single product branded XV. The company operates a standard marginal costing system. The following information for the month of March 2023 is available to you. So whatever that is available to us is as follows. That is the budgeted production and sales for the month amounted to 6,000 units. The standard selling price of product XV per unit is 13,200. the variable standard manufacturing cost per unit are as follows. The variable standard manufacturing cost. So these are the budgeted details. The actual, Note 4 is giving us the actual results. The actual results for the month of March were as follows, where we were given, of course, production in units and the sales component. The variable production overheads are absorbed on the basis of direct labor hours. The opening and closing inventories of finished goods are valued at the standard variable manufacturing cost per unit. So we are asked here to compute, number one, the sales price variance. Number two, the sales volume contribution. Sales volume contribution, meaning that we don't have the aspect of course, what? The fixed costs. Direct material price, direct material usage, direct labor rate, direct labor efficiency variance. So I want us to work out this very fast within the next 10 minutes, then into another question, so that I can show you guys how easy the concept of variance is. So long as you master those modules I mentioned to us earlier on, then you'll always find that it will be easy for us to always do it, for us to always be able to handle it. So having that, I want to, of course, display my board. I want to display my board. Have that first. Okay, I'm removing this question. Make sure that, of course, you have it right. The first thing that we should always take about that it is upon us to have these formulas in mind. And once you have this case, that's game over. That's game over. Once you have these formulas in mind, that is game over. Understand that variance is simply the difference between budget and actual. Understand that variance is simply the difference between what? The budget and actual. Once you're able to have this one out, then game over. So let us see. Let us see. Believe that you have a question. The first case, what are we told? The first case, a good examiner told us that, you know what, we need to compute our sales price variance. And our sales price variance, already, we have it here, but it's not far. The sales price variance, I need to determine my selling price and actual price measured into the actual quantity of units sold. So let us see. Here being our question. We need to identify what is our actual selling price. Actual selling price, we have how much per unit you're given there. How much per unit? 13,200. Note number 2. The standard selling price of product XV per unit is 13,200 minus our actual price per unit. What was our actual price per unit? The details for the actual results we were given in note 4. So our selling price, actual selling price per unit, we can see that the total sales we had 81,075,000. This was in relation to 5,640 units. So this is to say that our value in terms of our price be having how much? That should be, of course, we take 81,075 divided by 5640. to get a value of 14,375. So you take 14,375 to be our actual price. How many units are we actually selling? The actual units sold, in this case, as per our question, it is the same units that you're having there, 56, 40. So these are the actual units that you are selling, 56, 40. So we take the 56, 40 here. The actual units that you're selling, 56, 40. So to determine our variance will always be very easy. You can always determine your variance by just looking at the values in your bracket. You have planned to sell at 13,200. You ended up selling at 14,375. So this difference, is it in favor of us or is it against us? Someone? By looking at this value in our bracket, you had planned to sell your unit at 13,200, but you ended up selling at 14,375. So this difference, is it in favor of us or is it against us? We're just looking at the items in bracket. Yeah, this difference is in favor of us. So therefore we take 13,200 minus answer times 5640. So this will give us a variance of 627, and this is what? Favorable variance. Selling price per unit, budgeted, minus actual selling price per unit, we multiply by our actual units sold, actual quantity. Actual quantity, actual quantity. That is very important for us to know. When you're using a question, make sure you ask. If at all you go to another question here,
Mwalimu, why are we not using the 6380?
6380. That is production in units. And AQ, we want to look at the actual units sold. You see number 4. Production in units is 6380. But what about the units that you sell? The units sold, you're given here. Sales, 5640 units. And this is the value of the sales. That's the reason why we're using 5640 and not 6380. In order?
Yes.
Right. Higher. We look at the next item that you are asked to do here is to determine our sales volume contribution. So our sales volume contribution, anytime you talk of contribution, that is to say, we rule out any component of fixed cost. So therefore, my sales volume variance, where we don't have the fixed production or where the fixed overheads are not absorbed into our production. So we will take our budgeted output, whatever that we sold, minus our actual output, we value it at our standard contribution margin. Remember, contribution margin, in this case, all that we are talking about is simply the difference between our selling price per unit minus variable cost per unit. This is what will give us a contribution margin. Selling price per unit minus variable cost per unit will give us a contribution margin. So, according to our question, whatever that we budgeted to sell, whatever that we budgeted to sell, we are given the budgeted production and sales for the month amounted to 6,000. So we take 6,000 units. The actual sales, 56.40. Standard contribution margin. Contribution margin, you say it is selling price per unit minus variable cost per unit. So if we check our question, if you come check your question, our standard component, which you are given note 3, our variable cost we had 42.25, 23.50 plus 16.75. That is note 3. Direct materials, direct labor, and the aspect of variable production overheads. The total cost, if you sum them up, you're getting 82.50. So we can agree that my contribution margin, therefore, will have whatever that we budgeted as our selling price, which was 13,200, with less the component of cost, which we've seen the variable cost there would be 82.50. So that our contribution margin will be 13,200 minus answer to give us 59.50. So these are contribution, standard contribution margin. Standard contribution margin. So we multiply by 49.50 to get our sales volume variance. So at this point, one easy concept that we need to identify with A, you had budgeted to sell 6,000 units, but you ended up selling 56,000. That's when they look at that. Your favorable variance of your customer. Do you have a favorable variance or adverse variance? Just by looking at this case, you budgeted to sell 6,000, you ended up selling 56,000. So my question is, do you have a adverse or do you have a favorable variance by just looking at the variables here? Yes, you can give money with that very fast. I know you can give money with that. Sales volume, production. You had budgeted to sell 6,000. You ended up selling, of course, 56,000. So we can see that I am selling less units than what you had anticipated. So therefore, this variance, of course, it is against. It is against us. If at all it is against us, then in this case, we should be having what? Adverse variance. So call 6,000 minus 56,000 times 49.50 to give us a variance of 1,782,000 being what? Adverse. You're through that. You're through that. You're through that. You are with that. Where you have a question, make sure you ask. So you go to the next part. Direct material price variance and direct material usage variance. Same concept will apply. Same concept will apply where we need to determine direct . we're told, of course, number one, we are asked to determine this variance, that is direct cost variance, in terms of you ask direct material usage and direct material price. So material price variance. Mwalimu give us the formula, because the secret is just to get to understand that formula, where I want to look at the difference in pricing here. So standard price minus the actual price is the actual quantity. This is the standard price per unit of measure the material minus actual price per unit of measure the material, then the actual quantity of the material. Then the actual quantity of the material. So that should give us what? If you check our case, most of these items will always be given directly. So let us check, let us see. Standard price for the material, we are told 2.5 kgs at 1690 per kg. That is not number. That is not number, of course, what? Not number 2. No, number 3. Direct materials, 2.5 kg at 1690 per kg. We less the actual price of the material. The actual price we have as follows: direct material purchase and used. Note 4. Direct material purchase and used, we are given 14,730. And the total value of the cost, we are given a value of 27,987. So we need to determine then what would be our actual price. How much did we actually spend to purchase 1 unit of this unit of measure? So we have 27,987. We are going to divide by the number of units here, or kgs, that we had, 14,730 kgs. So this will give us how much? This will give us 27,987,000 divided by 14,730 to give us 1,900. Mwalimu is getting here 1,900. You can confirm with what you're getting. So having 1,900, I'll have my 1,900 at this point. The actual quantity of the materials that we sold being 14,730. You had planned to spend 1,690 on purchase of 1 unit of measure. You ended up spending 1,900. That is to say, you spent more than what you had anticipated. So that as at the end of the day, we should be having 1,690 minus 1,900 times 14,730. And make sure when you're having a fortune, you ask. We're getting, or Mwalimu is getting, a value of 3,093,000. This is what? Adverse. Confirm with what you're getting. Mwalimu is getting 3,093,000 adverse. What is the next element? The next item here is key. The next item here is key. We consider material usage variance. Material usage variance we talked about our standard quantity minus actual quantity valued at the standard price. One thing we agreed is that you'll never be given your SQ. You'll never be given your SQ. So that for us to determine our SQ, if I told us to take it back, we said we'll be talking about the standard quantity per unit times our actual units, because you'll never be given that one. At no any given point will you ever be given that one. So that's how we can identify that. That's how we can identify that. Very important to consider. Very, very important for us to consider. So once you have that in mind, this will be the next element, yeah? Determine our SQ. To determine our SQ identified based on our question here, the standard quantity per unit, what did you have on a per unit? Whatever that we had on a per unit basis, that is note number 3, we had planned to use 2.5 kg per unit. Times the actual units that we used, production units. Actual production units, we can see we're given 6380. So standard quantity per unit times the actual units. Standard quantity, 2.5 kgs per unit times the actual unit that you're having. So that at the end of the day, this would give us how many units in total? 6380 by 6.5 by 2.5 give us 15,950. 15,950. See? So that at the end of the day, determining our material usage variance, we're going to take the standard quantity with less the actual quantity times the standard price of a material, which is 1690. You had planned to spend on 15,950, but you ended up spending on 14,730. So we agree that we do have a favorable variance. We do have a favorable variance of how much? 2,061,800. This is a favorable variance F. That is favorable variance. Favorable variance, favorable variance, favorable variance. Favorable variance, yeah. Favorable variance. You can see here, Nikon is telling us here is 300, correct? So the end. So I need that 3, still okay, but go take that value. So these are favorable variance because I planned to spend on 15,950. We ended up spending on 14,730. imagine whatever that is guiding us here is what we had looked at earlier. Yeah, what we had looked at earlier on. Higher. Consider the other part here, which we are considering the direct labor rate. Labor rate variance. Nothing will change. We are considering your standard rate minus actual rate measured into the actual hours. How much do you plan to pay per hour? 1880. How much are you actually paying per hour? That is not 4. We paid a total. We paid a total of 15,363,000. We paid a total of 15,363 for how many hours? For 85.35 hours. 45.5 hours. So then what will we be having here? 15,363 divided by 85.35. So we get 1,800. So therefore, my actual rate is 1,800. And the actual hours, 85.35. What is happening here is that you had planned to pay 1,880, but you ended up paying 1,800. We can see that this variance is in favor of us because I am paying, this is an expense, these are costs. We are paying less than what we had anticipated. So giving us a variance of 682, 800 here, which is a favorable variance. See? Which is a favorable variance. Labor efficiency. I want you to do that for money so that you also participate because you decided you're not talking. Labor efficiency variance. Do that for money very fast. And you can. And you can. You have a formula. Give that for money. Let's do that very fast. Labor efficiency variance. Labor efficiency variance. Same concept should apply. Where Molimo guided us, it said that number one, you never be given your standard hours in the whole coming. You less your actual hours. At this point, this is valued at what? Our standard rate. So you never be given a SH. That's the same case as you never be given your SQ. Let's do this fast so that you can check another question. What is our standard hours? Income? Your standard hours is? Anyone who has determined the standard hours? Standard hours, yeah?
79.75.
How much?
79.75.
79.75. Okay. So let's see. Because you say that this one will never be given, where you're talking about your standard hour per unit, since your actual units. So like in our case, the standard hours per unit, if I told you that check on note number 3, direct labor hours we had 1.25. We multiply by the actual units, which in this case, our actual units are what we had, that was 56, not 5640, but we are determining somewhere our actual units. These were 6,000, yeah? 6,000. 6,000.
63.80.
That is not 6,000, but 63.80. See? What you had there, 63.80. That was the in note number, of course, note number 3, note number 4. Production in units, 63.80. So that as at the end of the day, we should take our value to be 1.25 times 380. 1.25 times 63.80, which would give us 79.75, correct? So once we have 79.75, it would be easy then for us to determine our labor efficiency variance, where we take now labor efficiency variance to be your standard hours, 79.75. We less our actual hours, which in this case was 85.35. 85.35. We multiply by our standard rate. And the standard rate, we can all see that we had a standard rate earlier on of 1880. 1880. So we had planned to pay on 79.75, but we ended up paying on 85.35. So that is to say that at this point, I'll be having, of course, an adverse variance of 560 by 79.75, which will give us 4,466, which is adverse variance. See, so these are what we expected to do in that question, which clearly you can see that it is nothing complicated. Just upon us to see or to identify, of course, the values that we are having in terms of substituting them in our formula. That is all that we need to have. So consider this question now in our paper, advanced MA paper. Talk about this question. It was not tested that a long time ago. A very good question. So you're supposed to do a reconciliation. Go to August 2023. Advanced MA paper. August 2023. August 2023, question number 3. August 2023. There you go. There we go. So you're told that Zeta Limited manufactures one standard product branded Bomber and operates a system of variance analysis using a fixed budget. As the assistant management accountant, you are responsible for preparing the monthly operating statements. So the budgeted information on product Bomber for the month ended 31st July 2023 was as follows. These are the budgeted information. Note 1, additional info, you're told that Zeta Limited budgeted sales and production for the month of July 2023 was 10,000 units. The annual budgeted fixed overheads were 14,400, which are assumed to be cut evenly throughout the year. The company uses marginal costing system for internal profit measurement purposes. The moment you've been told marginal is variable component, meaning that at this point, you are not absorbing your fixed overheads towards your production. That's why the good examiner specified what the marginal profit measurement. The actual data for the month of July, now the actual results were as follows. We are required, number 1, to prepare budgeted profit statement. Number 2, the actual profit statement. Number 3, a reconciliation statement of actual profit and budgeted profit. We need to show all planning and operating variances. That is easy, my good students. Profit is just profit. Take your revenue minus expenses. Your aspect of profit, both for budgeted and actual, they follow the same principles. And see the marks that you're given. So many marks, 12 marks are simply marks that can take you places you've never seen before. How do you go about it? This is what you need to do. So I want us to prepare our profit first, both budgeted and not budgeted and actual profit. That's what you need to prepare. Budgeted and actual profit. So we need to prepare that. So the procedure is just the same. You don't need to start working. Procedure is just the same. So profit is profit. Profit, whenever you are required to prepare profit, is all about taking our aspects of revenue minus expenses. So we have our budgeted profit statement. Budgeted profit statement. We say the question that we're doing. We say the question that you're doing is 2023, August 2023, question number 3. So, determining our budgeted profit statement. We need to determine, in this case, we're given in units, so we can easily go with that, whereby you consider our selling price. There are 2 ways where you can determine the total, or because we're given in units, let us make our work much easier. Selling price, we're given 880. What about our variable cost? Variable cost, we can take total. Variable cost, we can take a total of, in this case, we can have, this is 880. Yeah, times the sales units we are budgeted to produce and sell 10,000 units.
Our variable cost, we take our variable cost total 200 plus 150 plus 270 plus 60. We are in, of course, the cost per unit 200, 150, 270, and 60 to give us 680 times the number of units that we produce and sell. So that at this point, this should give us 880 by 10,000, 8.8. We take 680 by 10,000 to give us 6.8. 8.8. We less our value to give us 2 million. These are our contribution. So once we have our contribution, my good students, we less our fixed OHDs and fixed overheads. What are we told? If you check, of course, note number 2, the annual budgeted fixed overheads were 14,400, which are assumed to be incurred evenly. And the data that you were given was for July only. So fixed overheads, we take 14,400,000 divided by 12, which this case should give us 14,400,000 divided by 12, which would give us what? 1.2. So that our profit we will have then the 2 million minus 1.2 give us 800,000. This where my contribution margin we have 880 minus 680. That is our contribution margin. Whatever that we had here, selling price per unit minus variable cost per unit. When you have a question, make sure you ask. Believe me that you have a question. When you're having a question, make sure you ask. You have the question paper there.
Mwalimu. Hello.
Yes.
Mwalimu.
Yes, please go ahead.
Just a small one on the variable costs. That's 680.
Yeah, that is 680.
I didn't pick it, man.
That is 680. Remember where, you know how we determine the 680? We've taken our data here. Summation of, we've taken 200. Look at the cost per unit budgeted. 200 plus 150 plus 270 plus 60 to give us the total variable cost, which is 680. You've seen that?
Okay, I've seen.
Yeah, so that is how we determine that, okay?
Yeah.
So we have our actual profit statement. Actual profit statement. Same case, take your sales minus your costs. Take your sales minus your costs. Like in our end, we can see that was given in note number 4. We have actual production in units sold. So our sales will be having the actual price of 900 times the number of units that we sold, actual 9,000. This will give us a value of 900 by 9,000 to give us 8.1. Consider our costs, variable costs. Or in this case, you're given all our costs. So under variable costs, you just take directly the values that you're given. Among the values that you're given, we have, that is material A. So material cost, we have 2090. We add 1414. So this will give us 2090 plus 14. 14 give us 3,504. We have direct labor. Direct labor, we're given, of course, a value of 520, that is 2736. 2736. We're given a value of variable OHDs, where we're given 520. So that our contribution we're going to have 35,04,000. 35,04,000. We add 2736. 520.
The board clearly, please.
Yeah, you're saying?
I can't see the board clearly.
The board is not, let me see. It should be clear, I think.
It's okay.
The board is not clear. Yeah? I think it should be okay. Maybe we just had a little fluctuation, but I think the board should be okay. Kindly confirm if at all it is okay now. Is it okay? So our fixed overheads, if you check our fixed overheads, the actual, we were given 1160. So 1160. So that my profit would be 1340 minus 1160. Give us a value of 180. Give us a value of 180. So those values are very important. We note them somewhere. So whatever that you computed, these are what you're asked. Look at the question. You are told to compute a budgeted profit statement and the actual profit statement. And that is what you've done. And that is what that is what, it was simple, yeah? It was very simple. Just in your calculator, yeah, these were 2 marks, yeah? 2 marks only, because literally everything You don't need to struggle. You're given everything there. Higher. So this is 2 marks to marks. Look at note 3. A reconciliation statement of actual profit and budgeted profit. Show all planning and operating variances. Number one, you realize that these profits are not the same. We have difference in our profit. And why do we have difference in our profit compared to budget and actual? This is where the variance will come in. Variance is simply the difference between the budgeted and the actual. And you can see from our case that, at this point, they are not the same. We have a difference in profits. So we need to compute our variances to make sure that we go ahead and do our reconciliation. So the question would be, how will you compute our variances? Remember, there'll always be a guide. You see all these components that you're given, the sales, material, labor, overheads. These are what you're going to use to compute our variances, including all the overheads, except that we won't compute the overhead or fixed overhead volume variance. So in this case, then we need to start by considering our sales variances. Consider your sales variances. Number one, we start by looking at our sales price variance. Let the formula to always be, the formula will never change. You consider the difference between your standard selling price and actual selling price of this valued into what? The actual quantity. So by doing this, what will we have? Our actual selling price per unit, we had 880. That is standard selling price. Our actual selling price, you can see, we have what? 900. The actual quantity of units that you're selling, we have 9,000. So this will clearly give us what? Our selling price or sales price variance. Question? So we had budgeted to sell our product at 880. We ended up selling it at 900. The question that you need to ask yourself is, are you dealing with favorable variance or are you dealing with adverse variance? You can see it is favorable because you are selling more than what you had anticipated. So we have 880 here minus 900, which will give us, of course, times 9,000, which would give us 180, which is favorable. So we have 180,000 being a favorable variance. Consider our sales volume variance, budgeted output minus actual output, valued at our standard contribution margin, because we are told that they were using, of course, the marginal concept, meaning that we are not absorbing our fixed overheads into our production. So budgeted output, we had budgeted to produce and sell 10,000. We ended up producing and sell 9,000. Our contribution margin, we had already computed to be 200. So by 200 here. So our variance therefore would be 10,000 minus 9,000 here times 200 to give us an adverse variance of what? 200,000 adverse, because we are selling less than what we had anticipated to sell. We had planned to sell 10,000, but we ended up selling 9,000. So it is less than what we had anticipated. Very important to consider. Because the other part we aren't told to either compute the aspect of price or usage. What the good examiner gave us is material. So we can go ahead and compute what? Material cost variance all at once. Material cost variance. And you know very well that for us to compute material cost variance, all I'll need to do is to have my standard quantity times our standard price with less actual quantity times our actual price. This is the budgeted material cost with less our actual material cost. We know very well that this SQ you will never be given. SQ, we said you will never be given. So to determine SQ, we should be having our standard quantity, of course, per unit here, times our actual units. So that we can agree and say that our actual units, we should be having what? Our standard quantity per unit. Based on our question, we can clearly see that you're given for the two materials, A and B. So we start with SQ for material A. We will have what? Consider a value which is 2 kgs times actual units 9,000, and material B, you have, of course, your value of 1 liter times 9,000, determining our SQ, so that our SQ we should be having for material A, that should give us 18,000. Material B, that should give us 9,000. Okay? So once we have that in mind, what is the next item to consider is to work out our cost variance directly. So we start with material cost variance for A. We have our SQ, 18,000. We multiply by standard price per unit as per what you are given by a good examiner. You are given the standard price for material A to be 100 with less our actual cost. Actual cost for material A, we are given directly there to go to 2090. For material cost variance, for material B, we have the 9,000 here times the price, which in this case, of course, standard, we're given a value of 150 per liter. The actual material cost for B, we can see we're given 1414. So that as at the end of the day, we have our cost variance as simple as that. Or better still, you can go the other route, you divide, you determine one, then you multiply directly. So that is also another route that you can have. But in this case, you're given directly. So that's why Manu is just taking directly. So that in this context we have of course, we will consider 18,000 by 100 with less 2090 to give us, we had budgeted to spend 1.8, but we ended up spending 2090. So I'm having a variance of 1.8, which is what? Adverse. Whereas material B, we had planned to spend 1,350,000, but we ended up spending 1,414,000, giving us a variance of 64,000, which is adverse. Which is adverse. This is 180, not 1.8, yeah? This is 180. That is 18 by 100 minus 2090. That is let us do this together again slowly. We have 18 by 100 minus 2090. 290,000.
The answer is 290.
90,000. Correct? Adverse. Whereas the other one you have 9,000 by 150 minus 1414. Adverse 64. You see? So if at all you're given directly, just work it out directly. And that's what we've done. Consider the other item, which we have the other component, labor. So you can work out labor cost directly. So allow me to raise here. Labor cost variance. Labor cost variance, yeah. Anytime we are required to determine our labor cost variance, we should take our standard hours that will never be given times your standard rate, you less your actual hours times your actual rate. This is what Mwalimu gave us. And that is what, of course, we can split it into two, the aspect of the labor rate and labor efficiency variance. Again, one thing that will stand out, you'll never be given a SH. You know very well you need to determine your standard hour per unit times your actual units. This is what we need to have. So if at all we check our standard hour per unit, or rather standard hour per unit, what were we given? In our case, standard hour per unit, direct labor, we're given 3 hours. So you take your 3 hours, times the actual units, which we had to be 9,000. This will give us 27,000. So then, my labor cost variance, with a lot of confidence, you can say, we have 27,000 by our standard rate, which we're given 90 per hour, we less our actual labor cost that we paid, direct, or rather the labor cost that we paid, you can see we're given what? 2736 directly there. So 27,000 times 90, we less 2736. This will give us what? Your 6 adverse. You can confirm on your end. 6,000 adverse. 306,000 adverse. 306,000 adverse.
Your song.
Make sure that you're muted if at all you're not asking question, yeah? So once we have that case, the next item to consider, we should read about the variable overheads variance. So consider your variable overhead variance, which in this case we'll be having variable OHD variance. We start with the first one, which is a variable overhead expenditure variance. We should be having our standard variable overhead absorption rate per hour times our actual hours. That will give us our standard with less our actual variable OHDs. This is what we said. This is what we said. So, if you check in our question, my good students, if you check in our question, variable overhead, we are given 3 hours at 20 per direct labor hours. So this was the absorption rate per hour. 20 was the absorption rate per hour. So you take our 20 per hour, we multiply by the actual hours. According to our question, in this case, we had actual hours to be actual hours. We were given direct labor hours incurred, note number 4, we had 28,500. 28,500. So times 28,500 hours, we less by our actual variable OHDs, which you are given a value of 520,000. So that as at the end of the day, what will we be having as our variance? 20 by 28,500, which will give us 570. We had planned to spend 570, but we ended up spending 520. So I'll be having a variance of 50,000, which is favorable. 50,000, which is a favorable variance. 50,000, which is a favorable variance. What about expenditure? Variable over efficiency, that's the case. Variable overhead efficiency variance. We said we just compare our SH minus our AH valued into our standard variable overhead absorption rate per hour. See, where SH, we've seen it, we've computed our SH, which is what? 27,000. We have our actual hours, which is 28,500. Standard variable overhead absorption rate per hour, we had to be what? 20. So therefore, to be a variance there. We had planned to spend on 27. We ended up spending on 28,500. By 20, we get 30,000 adverse. $30,000 adverse. 30,000 adverse. 30,000 adverse. Very important to note, yeah. So once we have achieved that, then of course we proceed to the last bit, which is a fixed overhead, fixed OHD variance. And because we are using the marginal, then we won't be required to compute the fixed overhead volume. The only bit I'll be required to work out is the fixed overhead expenditure variance, where we say this is very easy. You just take your budgeted OHDs minus our actual OHDs. Just take your budgeted OHDs minus our actual OHDs. In this case, what will we be having? Yeah, moment here. At this point, we should be having our budgeted overheads minus our actual OHDs, yeah? So that as at the end of the day, where are my marker pens? Okay. So that as at the end of the day, we take whatever values that we're given directly there, which our budgeted OHDs, we can clearly see the good examiner had given us a value of 14,400 per month. We had already worked it out, 14,400 per year. So per month, we got a value of 1.2. So we take 1.2, we less our actual overheads, fixed overheads, which were 1160. So that we can see we're having a favorable variance of 1.2 minus 1160 to give us 40,000, which is favorable. So my good students, the next question will be, after we are done with all these variances, how then will we do our reconciliation? How will we do our reconciliation? Reconciliation will be very simple. Mark for me all these values, we are going to use them. Mark for me all these values, we are going to use them. So sales price variance, we've seen it is on 80, which is favorable. We have sales volume, we've seen it is 200, which is adverse. I can see material cost variance for A, I have to 90,000 adverse. And this other one, B, I have before adverse. I want to erase this part. That's why I am marking them there. So at this point, consider all the variances that we have computed. Consider all the variances that we computed. So that when you're dealing with our reconciliation, statement here, this will be easy now. Reconciliation statement of our variances here. Reconciliation statement of our variances, it will be easy.
Consider profit as per the budget. How much did we get? Someone, mine are the resident, I didn't mark it somewhere. What was our profit as per the budget?
800,000.
We have 800,000. We've made some adjustments in our variances. So these are the adjustments from our variance that we've computed. The first case, we have to consider favorable and adverse here. So we have the sales price variance. We had a favorable of 180,000. Sales volume variance, we had an adverse of 200,000. Material cost variance, A, we had to 90,000 adverse. Material cost variance, B, we had 64,000 adverse. The reason why Molimu was marking them so that I can easily pick them there. Labor cost variance, we've seen we have an adverse of 306. Variable overhead expenditure variance, we have a favorable of 50,000. Variable overhead efficiency variance, we have a value of 30,000 adverse. Variable overhead, that's not variable, but fixed overhead expenditure variance, we have a favorable variance of 40. So, sum for Mwalimu all this data. $200 plus 290 plus 64 plus 306 plus 30. Which in this case, I'm getting 890. Confirm on your end. Favorable 180 plus 50 plus 40. I'm getting 270,000. Confirm. So we have favorable to 70, adverse 890. So to 70 minus 890, you're getting an adverse of 620. So this is negative 620, but it is a negative value. This is negative because adverse is more than the variable. So that whatever value that I'll be having here, this will give us profit as per the actual budget, or rather as the actual, not as the actual budget, but the actual profit statement. Actual profit. Actual profit, then we take profit as per budget, we adjust it to the variance, which is an adverse of 620. So 800 minus 620 to give us 180. So you confirm with the budget actual that you had prepared, the actual profit statement that you had prepared.
it should give us 180,000. It should give us 180,000. It should give us 180,000. You confirm with what you had prepared earlier on. It should give us 180. So this case, whatever that we've done, simply we've done our reconciliation statement from the budgets that we're supposed to compute. We've done our reconciliation from the budget that we had computed. This is what the variance entails actually. These are all the basic variances. Okay? Basic variances. Basic variance. It is not complicated. It's as easy as how it is like that. It is as easy as how it is like this. Any question on that? Any question? So we need to check it out well. Any question? Great. I've been told that Friday is a holiday. Is it true? Friday is a holiday, right? Friday is a holiday. I think Muslims, they are celebrating something on Friday.
Yes.
Yeah. So then Friday, it is which holiday? Which celebration is that?
Eid, I don't know, Eid, is it Eid al-Fitr or Eid al-Adha?
Eid al-Adha.
Eid al-Adha, okay. So I don't know about Fatma. Can I rob your time like 1.5 hours that day only? Will it be okay
No
with you?
problem, Malim.
Okay, sure. Great. So
Come
Friday,
on, let her pronounce for us that holiday.
yeah?
Let her
Vanessa,
pronounce for us the name of the holiday.
Eid al-Adha.
Eid al-Adha.
Adha.
Yeah, that. Vanessa unasikia? Adha. Fatma ametuambia. So I think
That's
I
not
think
a sound for a Kenyan person.
yeah.
Hiyo si sauti ya Mkenya.
Hapana, mimi ni Mkenya kabisa. Fatma ni Mkenya kabisa.
Mi ni Mkenya.
Kabisa. So
Na
I think
pilau.
we'll discuss on a time
Yeah.
that maybe you can I can take another if I take another 2 hours of your time or 1.5, then we clear the advanced variance so that Saturday, God willing, we just start on a new topic. Saturday, God willing, we just start on a new topic. So let me confirm the timing. Then after I've confirmed the timing, I just post it in the group. But Friday, prepare yourself mentally. Of course, I'll communicate tomorrow in the evening, the time that we'll be having on a Friday. So that if at all you can take that 2 hours or 1.5, I think we'll clear the advanced variances, the one that has remained, so that God willing, Saturday, we just start on a whole new topic. And in that case, it will make us to be in a very, very good position. Because variance, the budget variance is always long. And once we clear this, we jump to the other pricing decisions or what we'll jump into next. I think we'll be in a good position. Yeah, so at that point, you guys have a very good night. Sorry for keeping you that much. See you in our next class. Good willing. Bye-bye.